Welcome everybody to the St. Louis Realtor Podcast. I'm your host, Adam Cruz, here with my co-host, Shannon St. Pierre.
Hello.
Hello. And we are working from home because of COVID, but we wanted to continue to learn and get excited about real estate stuff. So we're very happy today to finally have our guest on, Mike Pulley. And
Hey guys.
Mike does a lot of things. He's a rehabber. You're a contractor, right, Mike? You guys do all sorts of different stuff. You're an investor.
Yep.
And I'd love to, if you want to give us a little bio, but the main topic for today is all about velocity banking. And I consider you to be my local velocity banking expert. So thank you very much for coming on. Because velocity banking is kind of confusing, but also sort of simple in some ways, right? So tell us a little about yourself, Mike. And
No, great to be here. And so for those of you who don't know, my name is Mike Pulley, and actually Adam and I went to middle school together way back in the day.
Yeah.
Good old Crestview Middle School, man.
Really?
Right.
But not high school?
Not high school, no.
And you're still friends?
Yeah.
We pretend to be, at least. So, I'm just kidding. No, I grew up in real estate since the age of 5. We moved here to St. Louis back in the 80s, back when interest rates were in the high teens. My family moved here and my dad ended up working with a few brokerages throughout the years. And then in 1993, he branched out on his own. And predominantly all he ever dealt with was investors and commercial and industrial real estate. And so I grew up a lot being around that and helping my dad with open houses, helping him go out with investors, seeing the houses be really nasty to turn into something absolutely beautiful. And so did some architecture in high school, built a hockey rink from the ground up in Pacific. My uncles were contractors, so I grew up around that. And and then just went on a mission for my church for 2 years, came back. I'm like, oh, I love helping people. And went to Lindenwood for nonprofit administration and found out it was exactly that, nonprofit, after 2 years into the profession. And my wife wanted to be a stay-at-home mom, and just $32,000 a year wasn't going to hack it. And so we did our first fix and flip. This was back when, you had a pulse, you could get a loan. And back then the banks gave us like $500,000, like, here, just sign here. And a lot of that was based off of relationships that my dad had with the banks. And so we did our first fix and flip, and took me 90 days. Really, it was a month's worth of work, but 90 days because I had a full-time job. And we made over $41,000 and change. Actually, I got the check sitting right in front of me. It's $41,408.61. And so
so you keep your check from your first deal? I
do, yes.
Oh, that's awesome.
So yeah,
you never deposited. That's really nice of you. You never deposited.
I have a feeling it's a copy.
It's a copy. So I got it on my other computer monitor here, just kind of as a reminder, where we started from. And so did that. And, I went to my job and I said, hey, you know what? $32,000 a year. I just made $41,000. Peace out. Put in a month's notice. And 2 hours before I finished my last day, I got fired. So I think that was the Lord's way of saying, you're done. You're not going back. I thought I just think he's slamming that door shut, because, that was back in 2006 is when that was our first deal that we did. And so, I really feel like, 2 years later is when the market really went downhill. And I feel like had that not happened, I would have gone back into the nonprofit world when things got tough. And so I'm really grateful for that little lesson and whatnot. So that's me in a nutshell. Now fast forward, my wife and I, we've completed 179 fix and flips. We bought a bunch of rentals last year. We actually used to have 17 rentals, sold them all by 2015. Started acquiring again last year. My 13-year-old daughter actually bought her first rental last year too. So, now it's becoming a family affair. And my family loves working with me in the business. My wife's a realtor, and so we love having fun. We love doing real estate. It's fun because it's a hobby, but it's also a profession for us. So it's like we're never working.
We'll have to talk about how the process of your daughter buying a rental.
Yeah, maybe you guys
loopholes,
can do another,
baby, tax loopholes.
Tax loophole.
Well, yeah. So, but seriously, because I've talked to Milana, my daughter. She's 9 now, but she's kind of gone with me to go look at all the investment properties. She's watched rehabs. So I've told her, I'm like, you need to start now, and and I've
Right.
tried to explain the whole rental thing and how you make income, and then that's the way you save to get the next one. So she's like, wait. And I was like, you don't have to necessarily use your own money. And so
Right.
she was just like, hold on. So, but
She's
yeah, we
like, I
have
want to grow up
money.
and be a penguin, Mom, not a real estate person.
I know, I know.
Well, and I find it interesting too, because like you have all these people like, well, how's your daughter? How can she do that? And I'm like, you guys can do it too. You know, I was chatting with a realtor the other day on Facebook, and she's like, I want to learn how to invest in real estate, or I want to do investing in a couple of years. I'm like, well, why not now? She's like, we don't have the money. I'm like, and you thought my 13-year-old did? You know, she thought
Right.
she just had 20 grand lying around to buy a house. So, um, no, I mean, anybody can start it at any age in any position. And I mean, that's the beautiful thing about real estate, right? And it's definitely a commodity. It's needed. You know, people need a place to live. So,
And what we find in real estate is there's so many different niches and ways that people do it, and like concepts. And so today's all about velocity banking, which is I don't know if that's like a recent buzzword or if this is something that's been around a long time. I guess you can kind of give us maybe some of the history of it. And I know you have a kind of a presentation to share with us. And if it's okay with you, we're going to let you go ahead and go through that. And then Shannon and I will just really interrupt you constantly throughout the presentation with our questions.
awesome.
Does that sound fair enough?
Yeah, that's awesome. So I want to get to what you said about the terminology with velocity banking. You know, Renatus has really run off with that name and adopted that name as kind of their own. Most of the world might know it as forced equity, or in the financial world, you know, in Wall Street, they would call it credit swaps. So just shifting where your money flows, your revenue and everything like that, rather than depositing it into a bank. But I do need to go through a couple disclaimers before we start, and then we'll get into the presentation. And like you said, we can, you know, pause throughout the time, and I'll be asking you guys questions as well, and we'll kind of be talking about things as we go along. So
Great.
First things first, so let me share the screen here. So I'm going to go ahead and go into our disclaimers. So I am an independent contract marketer within Renatus. So what that means is Renatus is an educational platform that I utilize that helped me grow my knowledge base, especially in the last few years. Even though I grew up around real estate, Renatus has really given us that leg up. And so I'm an independent contracting marketer. So the things that I'm sharing are from there, and the things that I'm going to be sharing are examples as well. So I'm going to ask that you know, I'll do my best to give you all the information that you need to make an informed decision prior to, you know, especially implementing velocity banking, because you can get in trouble using velocity banking if you don't know how to do it properly. And you do have to be disciplined. So since I'm an independent contractor, I cannot bind or act with authority for it. And then also, I'm not a licensed attorney. I'm not a licensed accountant, a financial advisor, CPA. So any of the things that I'm going to share today, they're just examples, you know, either from my own personal life or just a scenario that we're going to be sharing in here.
Yep. So ditto for me and Adam.
And then there is intellectual property in here. So, you know, you can, I know we're recording this right now, but, you know, this is for the sole purposes of velocity banking and what we're going to be talking about today, and to be used outside of this. So, got it? Good.
Got it.
Got it.
So this is a hypothetical situation. And actually, I'm going to share, what's cool is when Renatus came out with this training and they use this hypothetical situation, this legitimately was my life back in 2007. You know, so we had already started investing in real estate by that point. So between 2007 and 2011. So I owned my house in 4 years, right? We did not get impacted as investors until 2010. So the delay didn't hit us for another 2 years. So this is our mine and my wife's second house. We paid $200,000 for this out in Charlestown, right next to Newtown, and our interest rate was 6%. And I just found it kind of ironic that when Renatus came out with this training, it matched up with my life, and it made it perfect for me to be able to share as an example. So, and what I mean by that is, if we look at our lives, let me move this.
Can I just say real quick, I guess we didn't quite say this yet, and you probably will, but so velocity banking is basically a tactic that people can use to pay down debt like rapidly, right? And you're going to show us how you did it to pay down debt on a house. But my buddy was telling me that he's using it to pay down debt like on his credit cards and his car loan and stuff like that. And so it's kind of this like super interesting tactic to basically pay off your any type of loans quickly.
Right.
That's
right,
interesting, Mike? Adam, because I always thought as velocity banking is really just all geared towards the mortgage. The whole goal purpose is to pay off the mortgage. I never thought about it as far as other debts because just because it's risky. I think I've looked at it as risky, but I think that's because I don't know a lot about it.
Well, Mike is going to show us all about it. So sorry to interrupt you, Mike.
Right. Well, and so just like Adam was saying, and I don't think a lot of people, when we share velocity banking, a lot of people think, yeah, this is only for home mortgages. No, anything that's amortized. So that's student loans, car loans, home loans. You can utilize that. Even if you don't own a house, people are like, oh, I don't need velocity banking because I don't own a house. I'm like, well, do you own a car? Do you have a payment on your card? Well, yeah. Or do you have student loans? I sat with one of my friends a year ago in our living room, and back when we could do that stuff, people could come over to your house and hang out. But we showed him how to implement velocity banking. It took him 20 years to pay off $30,000 in student debt. And we built out a model that night how in 18 months he could just, eliminate that other $30,000 loan that he had. And he just looked at me and started crying. He's like, you just saved me 20 years of life. And
That's
so
awesome.
it's really powerful for me. So let's jump into this. So
Can I ask you a question?
Yeah.
Sorry. I'm sorry. I told you we're going to have a lot of questions. You
That's fine.
just said earlier you can use this for any sort of amortized loan. And are you going to get into this later? Is there a difference between an amortized loan and what you were calling like a simple interest loan?
Yes, and I'll get into that. Yep.
Okay, cool. I'll let you go then.
So we're going to use this pretty much my scenario, and I'll just share with you. This is a majority of America and most of America, right? So most of America, they do have, they do have credit cards with, high balances on them. They do have, in St. Louis, the median home price is a little bit less than $200,000, but we're just going to say $200,000 home in this case. They typically have $12,000 on their car. And, I know rates are a lot less than 6% right now, but for the math of the model that we're building out here, we're just going to go with that. Same with the car loan and the interest on that. And then we got our line of credit over here where we've got 21%, right? So we got 21% interest on that line of credit. So we have $5,000 of income coming in. So that's my net take home pay, right? So I got $5,000 coming in, and I have $1,200 going to my mortgage payment. I have $600 going to my car. I have $600 going to my credit card. I have $1,200 going to my lifestyle. So for food and clothes and kids and, all that stuff. And then we have $1,400 going into savings. Now, we know that most of America is not saving that much, right? But what they are doing is, again, not a financial advisor, not a CPA, but typically at the end of in April or now July, when they submit their tax returns, what do they get? They get a refund. If they have a W-2 job, they get a refund. Well, congratulations, you gave the government an interest-free loan. But when the issue is that, are they so kind to you when you haven't paid them, right? So you're giving the government an interest-free loan, or again, not a financial advisor, but for me, I look at something and if it's not keeping up with the cost of living, right? So if people put money into a savings account. Adam, what's the typical interest on a savings account?
0.000000001.
Right, something like that. So I say if it has a point in front of it, it's pointless. If it has a point in front of it, it is incredibly pointless because you're actually losing money keeping that in the bank, right? If you have an old 401k or an IRA and you've got money sitting over there, it's not doing you anything, right? Because your employer's not contributing. It's just kind of sitting stagnant. It doesn't really grow. Again, not a financial advisor, not a CPA, any of that. But to me, personally, it makes sense. If it's not yielding me at least the cost of living and growth every year, why do I have my money there? Does that make sense?
Yeah.
So now let's look at this.
Well, why do you have like a big chunk of your money there? You'd think you'd want to keep some cash in the bank, but like,
Yeah, I
why
mean,
would
it's
you
always
keep
good
a
to
lot
have
of it
something. Yeah, it's always good to, and we'll get into that a little bit more as we go along. But
okay.
Shannon, what temperature does water freeze at sea level?
Oh, freezing point's 32 degrees Fahrenheit,
Okay, so Fahrenheit. What about Celsius?
0 degrees Celsius.
Okay, 0 degrees. So we look at that. So 0 degrees versus 32 degrees. It's kind of like you look at the interest, right? People look at the amortized interest, and they're like, oh, today rates are, Adam, what are rates today? Do you know? 3
Let's call it 3.5 or 4. I don't know.
3.5. So 3.5, and then they look at their credit card their statement. Like mine is like 22% or something like that. Well, they look at the 3%, 3.5. Well, that's way lower than the 22%. But if we look at Celsius versus Fahrenheit, yeah, 0 is definitely less than 32 unless you calculate it differently, right? So in this case, amortization is like Celsius, Fahrenheit is like simple interest, right? So 32 degrees Celsius is like 70-something degrees. So that is, you're definitely not freezing anything at 70-something degrees. So then we go into here, right? So same scenario, like 1 degree Celsius is warmer than 32 degrees Fahrenheit, right? And so people get so, I hate to say it, I love all my friends that are mortgage bankers and brokers, but the people are getting duped because they think the interest rates are so low. And in reality, we're going to go into what you actually end up paying in that period. So let's look at this. So you got 5,000 in, 5,000 out. Again, hypothetical situation. Loans are amortized. Now, what that means is, first of all, do you know what amortization means?
Over the life of a loan?
Mm-hmm.
Well, I don't. That's where I was kind of curious about the definition of that. Where, like, I know that, if I buy a house today, my first payment is like this much of it is interest and like this much of it is principal. And I think that's what you're talking about, right?
So you're talking about the mathematics, but we're talking about the term, like the Latin root for amortize means interest that does not die.
Oh.
And let's think about mortgage.
I don't think we like that.
And let's think about mortgage. What is the first part of mortgage? Mort. What other words have mort in them?
Die,
Mortality.
death.
Mortician.
So mortgage is death pledge is what mortgage means, is the Latin root for mortgage. So when death pledge.
Death pledge?
Death pledge. So you're pledging till your death that you're going to pay interest that does not die. Because what's the reality of somebody actually paying off a 30-year mortgage? It's not even 2% of America pays off their mortgages.
For real? I feel like my dad's generation did.
You're saying, Mike, you're saying because they don't stay in their houses for 30 years, or if they do, they refinance at some point?
Oh, yeah, they refinance at the next, oh, look, rates dropped. You can save yourself $200. Oh, rates dropped. You can roll in.
Rates drop, but then they take out loans or HELOCs to pay for college educations, which then extends it out, or you refinance to pay for college education. So when you had maybe 10 years left, now you're back to,
Yeah, so what we're going to cover today is how velocity banking will actually help you exponentially grow your net worth so you can, again, without it impacting you. Because most people, they're not, but like, Shannon, like you said, like my parents and my grandparents, their generation, they lived in it and they pay it off, right? That's just how they did it. And they built their net worth off of that. Our generation now and any generation after, they look at what can I afford, They don't look at what kind of equity am I going to gain out of it, because they just use it as disposable.
Yeah, that's totally fair. Yes.
So let's look at this. So lines are simple, right? So a mortgage is one way, right? You pay it down, and what do you have available? Well, if you have student loans and you pay it down, you don't have credit available out of there, nor do you want it, because it's like shackles for eternity, right? For your student loans. Your mortgage, you have theoretical equity, right? But how easy is it for you to get that equity? It's not very easy at all. You got to go to the bank, you got to do you got to get an appraisal, you got to get inspections, you got to make sure your credit's good, you got to make sure you have a job, there's all these hoops they make you jump through, and 20 to 45 days later, they finally give you your money back, and then you reset the clock all over again. Same with car loans. You pay down your car loan, what do you have available? Well, you don't have any equity because it depreciates so fast, and they're not going to give you any more money than what the car's worth. So versus the line of credit or lines, they're simple interest. When you pay it down, what do you have available?
No debt.
Well, you have no debt, but you have an available balance to use, right?
Right.
So lines are simple, and lines are expandable and contractible, a lot like my waist has been the last year. So
or right now, it's expanding
right.
for everybody, I believe, right now.
So I'm committed to not getting the 15. So
What's it called?
Quarantine 15.
Quarantine 15.
So, all right, let's go on to the next thing. So you guys have seen this, right? You guys have seen an amortization chart?
Yes.
Okay, so here you have your first payment is 950 goes towards interest, 250 towards principal. Or sorry, other way, 250 towards principal, right? Then we fast forward to 30 years, payment 360, and it flips, right? You have 250 going towards interest, and you have 950 going towards principal. I don't know about you, but 250 is a pretty nice date night, right, Adam? You could go to 801 Chop House and still get the appetizers and dessert and leave a tip, and then you.
I know I'm going nowhere but brasserie with my wife, so that's all there is to it.
There you go. So you can see here. Let's look at this, right? The average American moves every 7 years. How much equity have they gained in 7 years? If we look at this line here, they really haven't gained a lot of equity, right? But they've also paid a ton of interest. Let's look at what that interest turns out to be. In just say 4 years. We're going to use a 4-year example, right? So exactly my 4 years that I lived in my house. So let's change it to 4 years. In 4 years, 48 payments of $1,200, you're going to have $12,000 that goes towards principal and $45,000 that goes towards interest. So if I'm making $5,000 a month, so if my net take home is $5,000 a month, that's $60,000 a year. That means 3/4 of one of those years, I'm working for the bank. I'm working for the interest. Doesn't that suck?
One of those 3/4 of one of those 4 years, yeah.
Yep. So almost an entire year of those 4 years went to the bank.
Mm-hmm.
So, and only 1/4 of that year went to me in equity. So let's look at this. So loans, we want to get rid of loans as fast as possible, because what happens when times get tough right now, right? Times that are tough right now for people, they cut back on everything else, and for the responsible ones, they're like, hey, I still got to make my mortgage payment, I still got to do this, and that gobbles up everything, and that takes away from their ability to actually live a life, right? So lines are revolving. So when you use a loan, it gobbles up 100% of your cash flow, where principal is liquid inside the line. So we have two rules. This kind of goes along with our real estate educational stuff. So the employee mindset, we have a whole section that talks about the employee mindset versus business mindset, and the tax differences. And then we talk about the wealthy, how they use cash to create velocity. Because, Adam, you and I talked about this the other day. If you got cash and reserves, that gives you the ability to move quickly, right? So we have cash gives us that velocity. But when we have cash in the bank and we have good credit, what do the banks want to do? they typically want to just throw more credit at us, right? Because we can show to them that we know how to manage our stuff. So that's our rules there. So lines are better than loans, not lines over loans, not lines not loans, but lines are better than loans because you need
So wait a
one.
minute. Okay, so lines are better than loans. So lines of credit.
Correct.
Okay, so lines of credit. But then once you start using that line of credit, it becomes a loan, doesn't it?
No, because it's just utilizing you're utilizing your line of credit. So
Well,
it's a line
you can
versus
think
a
of
loan.
it as a loan, Shannon, but he's saying it still stays as a line and it's still using simple interest, not amortized interest.
Okay. Okay. So there's
Because
the
loans
difference.
have more
So
of a
simple
long.
versus amortized lines, because like once you pay it back, then you can still continue. It's like like a HELOC or a credit
Lines
card.
are
Right.
simple interest and loans are amortized interest.
Okay.
Correct.
Okay.
Correct.
So
So
lines are
let's look at
better
this.
than loans.
Then loans.
I got it. Like it. I like it.
So typically when you get a paycheck, where does your paycheck first go before you pay any bills or anything like that?
Taxes.
Well, yeah. So the the little gremlins come and take your money before you even see it. Yeah. For those who have W-2 jobs, they don't even see that money. It goes straight to the government, right?
So,
But any of the net income that comes to them, where does it go? Typically, it goes into a checking account, and then they just
Straight to the club.
let's not do
Party in
that.
the club.
So let's look at this, right? So most people put it into a checking account, and then they shift it into savings, and then out of there they pay for, their mortgage payment out of their their checking account, right? So they pay their mortgage, their car payment, their credit card payment, their lifestyle. Now what we do is we say, you know what? Adam, you already said it. The interest on a savings account is 0.000000 whatever, infinity like pi or whatever negative. So where your checking account, I mean, I've seen like a few banks in St. Louis. They're like, oh, we'll give you 3%, 3% interest on your checking account. We got money ebbing and flowing in and out of there so much that's just their ploy to have you put your money with them. But you're not making a ton because your money's ebbing and flowing. So there's no interest that's actually really accruing, right? So what if we do this? What if we take our $5,000 paycheck that we get every month and we put it into our checking account and then we pay off $5,000 on our line of credit? So say in this scenario, I have a $15,000 line of credit, but I owe $12,000 on it. Well, let's look at what that does. So if I do that and I deposit, and let's talk about this too. So if I got money going into savings and it's not keeping up with the cost of living, or I have my employer taking out too much money every month, meet with your CPA, meet with your CPA to figure out how much can we do without me having to come to the table with taxes at tax time, but where I break even, right? Because if you're giving them that money, again, it's an interest-free loan to them. You can do more with that in the scenario of velocity banking than just giving it away. So let's say we quit putting money into savings, and then let's say we pay $5,000 down on our $12,000. Well, that eliminates the $1,400 here that's going out and the $600 out here because the $5,000 counts as our payment, that $600 payment, right? So now we've freed up $2,000 a month in cash flow. So what that does is if I have $12,000 on my line of credit and I pay it down from 12, I put in 5, that brings me down to 7, right? But we already know I still have to make my mortgage payment. I still have to pay my car payment, and I still have my lifestyle, right? I got to get food for my kids. I got to pay for the clothes. I got to pay for their sports, all this stuff. So that's $3,000 because remember, we freed up $2,000 between the credit card payment and the money that was going to savings.
Am I putting those things back on my credit card? The food
So
for the
that's
kid
what
and
you're
all
doing.
that?
Yep. So for those of you who have a credit card with cash advance checks, like we do, we can use our cash advance check. We can take that and send our monthly mortgage payments to our bank for the mortgage payments, right? So we can take the credit card. Say we have a $15,000 line of credit on our credit card, and every month I can write out a $1,200 a month mortgage payment out of that. But then every month I'm paying down my line of credit with my income. So yes, you're going to pay for your life out of there. And some people, like your home equity lines of credit have the ability to write checks out of, just like a checking account. So let's look at this. So we've got $12,000, deposit our $5,000 into it, our paycheck. Then we have our living expenses. So we have our groceries, our clothes, our mortgage payment, and our car payment. That brings us back up 3. And then, the next month we put in 5. So we go from 12 to 7, back up to 10, deposit our 5,000 check. That brings us down to 5. Live again. That brings us up to 8. Deposit our paycheck again at month 3. That brings us down to 3,000. Then we got to live again. Brings us up $3,000. So what happens in this case? So people put money into savings for a myriad of reasons, but one of them is for emergencies, right? So people are like, well, why would I do that when I, might need my money? Well, if we have an emergency in, say, month 4, say COVID happened, right? Say COVID happened and you had already started doing your velocity banking. Okay, well, crap. I need living expenses. Well, if your living expenses are $3,000 a month, you have a $9,000 spread available in your credit card here, right? Or your line of credit to live off of for the next 3 months. Or let's have an emergency and you can pay that off in 6 months, right? So now what you did was you effectively took $12,000 on your line of credit and you paid it off in 6 months. And most of America has a pretty high credit. They have a lot of money on their credit cards, anywhere between $7,000 to $15,000. So this is a good example to show, like, hey, I know a lot of people are like into Dave Ramsey, and that's great. He has this saying, live now like nobody else will, so you can live later like nobody else will. But living now like nobody else will means living on beans and rice. I like steak. I want to eat steak now. I don't want to wait 30 years to have it well done. So in this case, we can have it paid down in 6 months. Then what can we do? Well, that frees up, a couple things, right? So if you show that you can manage your line of credit, typically the banks give you an increase on your line of credit if you've shown that you can manage it. Shannon, has the bank ever called to give you an increase on your savings account?
Oh, no.
No. But have they done it? Have they done it on lines of credit?
Yes.
Yeah, and Capital knows every time I go on vacation, because they always up my limit. Like big family vacations, they always up my limit by like a couple grand. I'm like, you jerks, you just blew my budget. But anyway, so let's go forward in here. So now we have $15,000 available on our line of credit, right? We just showed you how to pay off your line of credit. And so now what do you have available? You have credit. So what if you go in and maybe you have a cash advance check out of there, or you have a home equity line of credit? You write out a check for the bank that is screwing you over with their high amortized interest, but you think it's 3.5%, you're paying nothing. You write a $12,000 check to the bank saying, hey, I'm going to pay off $12,000 in principal. And you write that check and you send it off to your mortgage company.
I write that check out of my credit card.
Out of your credit card or your line of credit or anything like that, right?
So out of your HELOC, which is a home equity line of credit, or your credit card check.
Correct. So then what? Well, now you got a $12,000 balance on your credit card again, right?
Yeah.
Just follow the same process again. Deposit your paycheck in. So you're going to deposit your $5,000 paycheck in. Takes you from 12 to 7, back up to 10, back down to 5, back up to 8, back down to 3, back up to 6, down to 1. And so in 6 months, you're able to pay off $12,000 in your mortgage in your principal. Do you remember what it took you to do that the traditional way?
4 years.
4 years. It took us 4 years.
I'm listening. See, I'm listening. 4 years for you. This example.
Right. So it took us 4 years to do the same. So effectively, let's look at this. So people are like, well, you remember the 21%. People get caught up. Especially, I love presenting this to mortgage bankers and brokers because they're like, well, Mike, there's 21% interest on that $12,000.
Which I have to say, Mike, that's exactly what's been going through my head. I'm like, well, where's the interest that you're borrowing? You're like, I'm paying back. Like your expenses are 3,000 in your calculation and in your example, but then you're adding in that
Right.
extra expense of the interest of
Now remember,
20% or whatever, or if a HELOC, it's 5.5, 5 right now.
right? So you look at simple interest. How is simple interest compounded?
Simple interest is compounded
On the
times
daily
12,
usage.
yeah, like yearly divided
On
by
the
12.
daily usage. Yeah, it's
Yeah.
based on the daily usage, right? So if you have a $12,000 balance and your month one you pay it down to 7, you're going to be charged on the 7,000 in interest, not the 12,000. And then every month it keeps going down. So let's look at this.
Okay.
So let's look at $12,000 on your line of credit times 21% divided by 2, so 6 months, right? Because in 6 months we can have this line of credit paid down. This is what you're going to pay in interest if you do not pay off that line of credit in 6 months. That's what you'll pay in interest.
So you'll pay $1,260.
Right. But here's what you will have saved.
Correct.
So I don't math good all the time, but is this less than this?
Yes. So $1,260 of interest of that 21% interest.
Saved you $45,000 in interest.
Don't I need to take 1,260 times 2 times 4 to compare it to the 45,000 over 4 years?
No,
it's still smaller,
because you reduced $12,000. So you did equivalent, right? So in 4 years you paid off 12 grand. In 6 months you paid off 12 grand.
Oh, you're saying even though it's a shorter time, I'm paying off the same amount.
Right. So you just did what took you 4 years to do, and it only cost you $1,200 in interest versus $45,000 in interest.
Okay.
Does that make sense, Shannon?
Yes. Yeah.
Big difference.
I'm getting
right?
there. I'm getting there. I like it. Yes.
So now let's break it down to my house, right? So with my house, right, I lived in my house for 4 years.
Mm-hmm.
Ironically, I was paying myself exactly what this model was, and my mortgage payments were the same, my lifestyle was the same, my car payments were the same. Everything was almost within $100, I'll say, within this model, right? So what sucks is we bought it in 7, we didn't get hit till 10, we had to short sell our house in 11, right? So you guys as realtors, say I have a $200,000 house, right?
Mm-hmm.
I bought it in 2007, and in 2011, it was actually worth less than what I bought it for, right? So I paid $200. We ended up short selling it. It was in great shape, but we ended up short selling it for $170. That's a $30,000 spread, right? I had only paid down roughly $12,000 in principal, right? Now, how much more powerful it would have been for me to have utilized the line of credit that I did have available to me at the time to, at least in 2 years, roll it twice, right? So in 2 years, that's 4 rounds that I could have paid it down, right? So in 2 years, I could have paid it down $48,000. So 12,000 plus 12,000 plus 12,000 plus 12,000. So $48,000. $48,000, take that off 200. So just say 50,000. Take that off 200,000. I could have short sold it myself and taken the loss rather than getting my credit decimated and walking away with absolutely nothing, right?
Yeah, I could have sold it and gotten a check versus short sell.
And we know too that the average list to sell price plus closing costs and commissions averages out to be about 10%, right? So if you have a $200,000 house, when you go to sell it, you're going to pay 10% between closing cost, commissions, list to sell price, after you do all the negotiations and, the inspection items and everything like that. Right. So already people are, in this case, say they bought it for 200, now they got to sell their house and they're taking a $20,000 hit on all that. And they've only paid down 12 grand. They're upside down $8,000. out the gate, right? Now, they don't realize they're upside down $8,000 because 4 years prior, they put down anywhere between 3.5% to 5%. So if they put down 3.5% on FHA, they're going to walk away paying $1,000 at closing. If they put down 5% using Fannie Mae, they're going to walk away with a $2,000 check at closing. But they're going to be like, I didn't walk away losing everything. I'm like, well, you did. It's a delayed pain. You lost it 4 years ago when you put it down. So that's assuming the market doesn't shift, but if the market shifts in a bad way, people are even worse spot. If the market shifts in a good way, okay, great. You got some equity. You got a little bit more equity traditionally. But let's look at this scenario here, right? So if we've got the ability to pay $24,000 a year down, 24 times 4 is what? I know we're doing math today. So we got $96,000 in 4 years.
Okay, I was
We
getting
paid
there.
off
Common Core math takes a long time, so.
I know. Us parents are getting messed up now. We don't even know how to do math anymore. We had to do this Common Core stuff. So in 4 years, you could have the ability to pay down $96,000. Now, all those 4 years too, we've also made 48 payments on our traditional monthly mortgage payments, right? So really what we've done is we've actually paid off around $110,000 in our mortgage payments. So traditional way, pay down, do your monthly mortgage payments like you do, and you pay off $12,000, or run everything through Velocity Banking through your line of credit, and you can pay off $110,000. Again, I don't math good all the time, but $110,000 sounds a lot better than $12,000, doesn't it?
Yes. Even in Common Core math, it is.
Right. Even in Common Core math, that still makes sense.
Absolutely.
So you follow this pattern until it's paid off in full. In this scenario, it would be 7.3 years it would take you. So the time it takes the average American to move, they could have their house paid off in that same time.
So in that scenario, it would take you 7 years, a little over 7 years.
Right.
To pay off the mortgage in its entirety.
Correct. Now that's if you're disciplined, right? Life happens, right? Holidays happen. Sometimes you're like, oh, I can afford to not make this payment this month, or I can afford to make the minimum payment on the line of credit. I don't have to, I want to free up some of my money, and that's where I said at the beginning, I'm like, you can get into trouble with this. I actually met with a St. Louis City police officer right before we went on lockdown, and I showed him this. He's like, oh my gosh, I wish I had known about this when we had our line of credit, because we wouldn't have filed for bankruptcy. We could have utilized this, and we wouldn't have had to lose everything. And to me, that was heartbreaking. And now his wife, like, they touched the hot stove. They don't want to touch it again. I'm like, but you guys have credit cards with cash advance checks. You can do it. And he's just like, ooh, I don't want to do that. And I get it. So
yeah. So go into I know what your next slide is. So the pros and cons. So the pros we kind of went through. The cons, though, are that you really have to be very disciplined.
Right. Well, so there's the discipline side, right? So you have to be disciplined, and unfortunately, most of America is not. And I will say, if anything that Dave Ramsey has done really good at is, look at America, right? Look at what's going on right now. We have a sickness, and it's called debt. Not just the country, not just like our government, but like us as individuals, we have a sickness with debt, right? We're addicted to it. That's why people look at like, how much can I afford versus how much equity can I get, or what's the longevity of this investment that I'm going to put my money into. So
right.
The con is, yes, you could get into trouble. You most certainly could. What's great is our educational company that we have. We actually have an app that we came out with that you can download on your phone. I'll give Adam the resources so he can put them on so people can go and download the app. But it really walks you through like when and how to make payments. But I really encourage people to get the education, awesome, because the education will keep you out of trouble, right? The more you watch the education, the better you're going to get at honing this practice, because and after a while it becomes a game. Like, it gets super exciting to be like, oh, I can pay this down, I can do this. And then it opens up the ability, especially when you start looking at rental properties, like, oh my gosh, I can buy this rental house and have it paid off in 5 years. and then that frees up cash flow, and you can do a cash out refi and go buy more houses and buy more houses and snowball that.
I'm not quite clear on what you're saying the like trouble is. Is that where someone would like get a really high credit card balance and then not be able to pay it off, or what's the trouble?
Right. Yeah, so the trouble is, I mean, COVID could happen, right? You got a job and now you don't have a job. So now you have this line of credit. The other trouble is your banks could, let's go through all the things that could go bad, right? That could go wrong. So you have, you could lose your job. And I will say, and Adam, you and I discussed this, this is great for people who have steady income, right? Like for realtors, it's really tough. For people that are commission-based, that don't have a consistent paycheck, it is really tough. But you and I have rentals, so we can run our rental properties through this and pay off the rentals, which then frees up more income for you, and for you to get every month, just as well as myself on my rental.
Yeah, that's right. I think that's what's been confusing for me, and like you said, as other people that have like incomes that do this, and I guess we could just figure out sort of a baseline income. I know that I make
Right.
at least whatever $3,000 a month, and I can use that number if I wanted to.
And that's where the discipline comes in, right? And then so the other trouble is people who aren't disciplined, right? People who aren't disciplined. Maybe something breaks on their house that costs a lot of money. Maybe their car breaks down and they have to make an investment in another car. Maybe they lose their job. Maybe COVID happens and the banks, on your home equity line of credit, they're like, hey, you're not utilizing this whole line of credit. We're going to cut it down, or we're going to eliminate it altogether. They could close that. Your credit card payment, your credit card companies could reduce the limit that's available on there too. So those are a lot of the things that could go wrong. But let's talk about what could go right. Gaining equity, right? The ability to build generational wealth. I mean, you think about it this way: in 7 years, in 7 years, in this scenario, Shannon would have paid off roughly $20,000 in debt in 7 years, versus being able to walk away with over $100,000, or not 100,000, almost 200,000 after commissions and closing costs. What does that give your seller the ability to do? Go buy another house. They can go buy a house twice as much and put that same money down into it and still have the same payments they had before, but now they got twice as nice of a house, which is great for you as an agent to be able to provide that service. So
because a lot of our clients, or many of mine, have been first-time home buyers, so just kind of getting their foot in the door with a small house, but the intention being, down the line, 5 years to that 7-year mark, upgrading to what would probably be a family home.
Right. Well, and one of the pushbacks I get from first-time home buyers is, well, especially ones that have built up a pretty good little nest egg. They're like, well, why don't I just put that money down on my house and pay it off faster? I'm like, well, cash is always good to have on hand, right, in case of emergencies. And if you have available credit, why not run it through here, through this? Because if you spend your cash, what do you have left available? You don't have any more cash. But if you utilize your line of credit and you start paying down your line of credit with your traditional income, what do you have available? We already talked about that. You have available credit.
That's something that was interesting to me. It's like, if I'm going to buy let's just call it $100,000 house, and I have the 20% to put down, I've got my 20 grand. Should I instead put down 5%, 5,000, and then month one, put down that other 15,000? Am I pay my first mortgage payment with the $15,000 check? Is that saving me interest?
It does, yeah. So what it does is it accelerates. I mean, that's why it's called velocity. It accelerates the payoff. So,
okay. But then devil's advocate here, though, because if he goes to that 20%, or if he doesn't pay that 20%, then you still have the PMI, and that doesn't go away unless you
hit 20%.
You hit that 20%, and some banks have a minimum time frame I've seen. So
I mean, here's the thing: is it going to work in every scenario? And is it going to? Yes, it could. Is it going to work perfectly in every scenario? Not really. So I mean, and Adam he and I were talking the other day. He's like, well, what if I have like $100,000 on credit? Why can't I just chunk down big chunks of them? Like, there's actually a careful balance between your available line of credit and what you should utilize to chunk down, those big payments.
And that's what
So,
you're saying, the Renatus app would help people figure out how much of their
correct.
credit line to use?
Correct. So, and again, going back to the education is going to help you. It's great to have, an understanding. It's great to see how it works, but it's better to have an understanding of how it works, right? And that's why, like, my wife and I were such big advocates for this education, because it's really helped us. I mean, we took a 6-year car payment and cut it down to 13 months, which saved us like $4,000 in interest. People are like, why would you do that with your car? Well, at the time, we didn't have any other personal debt because everything else was owned by the businesses. So we're like, we'll just run it through there. And, watching it now, it's depreciated so fast, but at least it saved us $4,000 in interest. And it didn't change our monthly expenses or anything like that. It just changed where our money flows. Because
is there some reason you wouldn't do it on debts for the business?
No, I would do it for the business. So we actually have another course called Advanced Velocity Banking, and that is solely for businesses, whether they are real estate businesses, regular business. I have a massage therapy clinic that utilizes it for their business. They own a bunch of franchises. They have like $1.3 million in debt, and they've been using it for the last year. And so they've eliminated, I think it's like $500,000 in debt in just a year by flowing all their cash flow through there. Through their line.
I get like sort of antsy when we talk about this because I'm still not doing it, and it's like,
right.
We've been talking about it now for a couple of years, and I'm just like, why am I not doing this? It's like I got to hang up now and go pay off something with my home equity line of credit.
And I think it's more people have the fear of it. That's why the education is so important, because the concept of it sounds great, right? The concept of it sounds amazing. Like, 4 years, I could walk away with $100,000 versus walking away with 2 or losing 1,000. I could walk away with $7,000 or with $200,000 in 7 years instead of, $10,000 after commissions and everything. So, it's people get so excited. Like, they come to our meetings, they come to our presentations, they get so excited. And then they just like, it's like they find out they're an eagle, they're hanging out with the chickens, and then they still walk home.
This saying, you said that saying the other day. What is it saying about the eagles and the chickens? So I come to your class, I become an eagle, but then I
find out you're an eagle. You're an eagle to begin with.
Okay,
I find out. But you've been hanging out with the chickens this whole time. You come to the class, you come to the introduction, you come to what we're talking about, and you're like, you find out you're an eagle, and then you leave the meeting.
So I fly home,
and then 2 days later you're back a chicken again, right?
And I'm walking again.
Right, because life happens, right? Things come up, and you get your mortgage bill in the mail. You get your phone bill. You get all these other things, and it totally takes away from your ability to like focus on it. And that's why the education is so important, because it gives you that structure. Like me, I say it gives me the ability to geek out. Like, oh my gosh, like implementing it is so key and paramount.
So tell me the saying.
The saying? Oh, I can't remember the saying.
You've been hanging out with chickens, which I take personal offense to that. Like, Adam is not hanging out with all chickens, okay? Me and his wife are personally offended.
You guys are eagles.
We are total eagles.
Or it could be, hey, you know what? It could have been, when I served a mission with, on my church, I had this Mongolian guy that I served with, and he was trying to learn English, and he didn't quite get it, but we were going by this university, and they had these cross-country girls, and he's like, the guy who started teaching him English before me taught him to say hot chickens instead of saying hot chicks. So we were going by, he's like pointing to all these girls, like, hot chickens, hot chickens. So, yeah, Adam, you're just working with a lot of hot chickens in your office.
No comment.
Yeah, he won't comment on that either. But I do like this. So now I think I get it though, in terms of the question of why not use the cash versus it's the same concept that we use in investment real estate is we're using someone else's money to kind of build that
Right.
wealth. So you're just using someone else's money, i.e. the credit line of credit or the HELOC, the home equity line of credit, to pay off other debt. And then you keep your cash, to buy, to invest elsewhere or to have off to the side for emergency funds and stuff. So
Emergency
I'm
funds.
definitely in that camp of keeping the cash and using credit to help benefit you if you're truly a
Right.
disciplined personality.
Right. So like my mentor inside of Renatus, he says he's got, at any point, he always makes sure that he has $20,000 in his business and $20,000 personal just for emergencies, right?
Okay.
Like, to have like quick access for, but that he's always utilizing the line of credit. And like for us, one of our credit cards we use, actually we get points on. So, we get to use that and that pays for our date nights. And,
I wanted to ask you about that. I didn't want to interrupt you earlier. When you write the check, the cash advance or whatever from your credit card, do you get points on that?
Mine does. I don't know if every card does that, but mine does.
I've thought about that. I've thought about that exact thing. Is going, why am I not paying my mortgage, by the way, with a credit card? But you can't pay a mortgage with a credit card, but you can, I guess, technically do it with
A cash
the
advance.
check.
Here's the other thing people can consider too. If you got student loans, they'll take the credit card for payments. If you got depending on who your depending on who your car loan is with, mine, they took my credit card. My Ally Financial took my credit card for payment.
Ally did? They're a bank. I'm surprised.
Now you have to call in. You have to call in and do it. They don't have it available on their website, but you have to call in and do it.
So
But then they
call in
charge
every
you like a
month?
little fee or something, don't they?
Yeah, but you figure it's a couple bucks to save me $4,000 in interest. That's to me, that's worth it.
Long game.
And I'm gonna get the points back. There's a couple dollar, the $2 or whatever, $2.50 I think it was process. I'm gonna get that back because my car payment's $500. 2%.
I ain't talking about no $2.50. I thought they're charging you like a percentage or something.
Like a 3%, 4% processing fee.
No, theirs was because they charged it like a Western Union type thing.
Okay, so do you have more slides, or is this the time when we just start hitting you up with random questions?
Just go ahead and hit me up with random questions.
All right, so my buddy who I was talking about that I was saying that is he's using Velocity Banking to pay down his credit cards, and then he'll pay off his car, and then he'll start paying off his rental properties that he has. He was mentioning something called an all-in-one loan. Have you heard about this? Can you tell me anything about those?
I'm not familiar with those. No, unless he's talking about like a there are some banks that do first lien position home equity lines of credits.
Yeah, something like that. He called it an all-in-one loan, but he started saying words like first lien position or whatever.
Right. So there is a few banks. There's a few mortgage bankers here in St. Louis that I know. I haven't talked to them since, the lockdown, but I right before we actually had breakfast with one of them, my wife and I did to, start utilizing them to market with our students inside the education. So I'm not as familiar with them. I've got a buddy that's in Renatus that's in Hawaii. He utilizes them heavily. A lot of those are geared towards private residences. I haven't found one yet that's for business. So,
okay. So does it's a credit union that I get a lot of my mortgages from for my rental properties. Will they hate me if I start doing this, or not want to give me any more loans, or do they not?
No, here's the thing is people are like, oh, I had one person say at one of the presentations, like, is that legal and ethical? And I feel so bad for the banks. I'm like, why do you feel bad for the banks? Because
I didn't say that. I just wondered if they would have a problem with it.
Let's do the math on that, right? So let's do the math on that, right? So $45,000 that we paid in 4 years, and then we paid $12,000 in interest rate. You are paying effectively 266% interest in those same 4 years.
Yeah, so that's the deal, right? We didn't quite make like a chart for that, but you paid 21% simple interest on your credit card, but even though your mortgage is 3.5% interest, that's over 30 years. So the first month, like you're saying, you know, if you're paying $1,000 a month and you know 100 of it is principal and 90 of it is interest, then that's a hell of a lot more than 3.5%. I don't know the math on it. It's not 90%, I guess, but it's way more than that 21%. And so then you need to like kind of figure out how old your loans are, don't you, before you would do this? And you should start doing it on like your newest loan.
Yeah, it's definitely better towards your newest. So like my cousin, I was out in Arizona a year and a half ago, and I stayed at his place, and I was breaking it down for them. They were 17 years into their 30-year mortgage, so they were on the downhill side, right? They were close to where, you know, they could do some velocity banking, and it would probably save them a couple $1,000s. But they had just bought a brand new minivan that was like 50 grand. I'm like, look, man. And I was like, what's your interest on that? He's like 7%. I'm like, dude, you're gonna pay way more than the, I think, $2,000 we did. We figured it out. It was like $2,000 or something like that in interest by the time, because he was finally just hitting that point where he could just start attacking the newer loan first. And now he's on to doing, he's already paid off, and now he's doing the other thing. And now he's back to his home mortgage instead.
But even if he has only 13 years left in his mortgage, it still makes sense to do it, I'm presuming.
Oh, yeah. No, I mean, it still does, but it also makes, I mean, he can do a blend of everything too. I mean, he had enough line of credit and he had enough income too where he could do a blended kind of velocity banking on each, right? So he could chunk over here and he could chunk over here, and he had enough income to pay down that line of credit.
We are sharing this live in our Hermann London like agent Facebook group. And so someone was asking, what is a good bank or credit card that they should do this with?
So the thing is, when you go to a bank and you ask for a line of credit, typically they're going to give you a loan application. And you say, no, I want a line of credit. And it'll take you a little bit to get through a few people to finally get somebody who knows exactly what you're talking about.
Wait, so if I have a HELOC, I need to verify if it's amortized or simple interest?
Right, because not all HELOCs are the same.
Huh?
Not all HELOCs are created equal.
Well, shit,
They're
I
not?
need to figure that out.
Huh. So
Right?
a HELOC is, I thought that, yeah, because I've had a couple. I mean, so,
Right.
but I think they're all simple interest.
And the most part of
And they're
them, they
lines
are.
of credit, technically.
Correct. Most of them are. I will say a majority of the home equity lines of credit. That's why it's a home equity line of credit,
Right.
not loan of credit. So,
Right.
but just double check that, because if it says loan application on there, they're typically going to be throwing you into a loan.
And then what's do you want to share what credit card you think is good that has like the cash advance and all that kind of stuff?
I mean, we have Capital Ones. We have Capital Ones, and we have a Capital One the Spark cards for our business that we can do that with as well. I will tell you this: the Spark cards, they actually tie to your personal credit. So if you load them up really high, it will mess up your debt to income ratio. So if you're trying to buy a house or anything like that, that's one of the other cons we didn't talk about was, you know, people who are looking to buy a house, if they load up their line of credit and don't pay it down soon enough before the billing cycle ends, then that could impact their credit score. So it is a careful balance, and it depends on what your goals and your objectives are. So
if you wouldn't mind, it would be helpful, I think, if you would take your credit card out and show the front and back of it for everybody.
Yes, that would be great.
That would be helpful.
I don't have it on me. It's actually in the other room. So
you almost did it, Mike. You almost fell for it.
I will say Chase does it too. Chase is I get those checks as well from Chase. I have a Chase.
And And if you don't have them, or if they've never given them to you, you can always call and ask your credit card company if they have them. So
And what specifically are we asking for? Credit cards
so
with
we've had
cash
a few,
advance?
yeah, we've had a few people in our community that they didn't have those cash advance checks. And so we just said, hey, just call your credit card company and see if they offer them. And then they offer them. And sometimes they're even 0%. They do charge like a 2 or 3% processing fee, but they're 0%. So it not that case for everybody, but in some cases they are.
Wonderful. All right. I don't know. I think I could probably think of 1,000 more questions if I wanted to.
I know. I mean, this has been awesome to actually run through some examples just because I've heard about it. I knew that it was there some big, huge benefits potentially from it, but I also
Right.
knew that there was risk, and I just didn't know what the risks were.
Yeah.
And but
And
I
it
think
takes
that's
some time. Like it took me watching our course 3 times to really, really grasp it. And then once I grasped it, I'm like, holy crap, now we got to get on this, right? And then
This
that's
is
when
the
you
right.
third
start
time I've
making
gone through this with you, so maybe I'm finally getting it. Maybe I'll actually do something about it. Mike,
I think it's
do you mind
awesome.
share with the people your contact information if you're willing to have people contact you? And then also, do you still, I guess not right now, but you were hosting kind of like a real estate get together type of thing, cash flow
Yeah,
game
so
nights and stuff?
we typically hold our introduction meetings to the education every Tuesday night. We're shifting that to Thursday. We're actually joining we have communities all over the United States. So we're going to be joining up with some of our other communities across the United States, just so people can get a different flavor of different markets and things like that, and see what people are up to across the United States. And that serves as an introduction. They typically cover velocity banking, like I did today, and then it's typically an hour and a half long, going through various real estate investing aspects. When we get back to normal-ish, I guess we'll get back to we were doing cash flow game nights once a month. Um, we do property house tours with those that are part of our community that have the education. We do a lot of fix and flip house tours. We'll do Burr house tours. We've done a few Airbnb house tours. We're gonna start picking that stuff back up and doing virtual tours coming up in the next couple weeks. So you guys can keep an eye out for that.
Cool.
So yeah, everybody's welcome to reach out, connect with me if they got any questions or whatnot. We've got a myriad of different resources that we can plug into. And
What's your
I
phone
appreciate
number, email, website, and all that?
Yeah, how do they
Um,
find you?
so here, I'll just do this.
I hear Jax, Shannon. Here he comes.
Click, 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 click. You hear the little
Uh-huh.
nails?
All right, so let me just do this real quick. Sorry, guys.
See, I
All
would
right,
go in
I'm
my
just
bedroom and hide, but then the kids and the dog stand out there and scratch at the door and pound on it. So it's no better, no matter what I do.
Hey, it's all good.
so there's my contact information right there. I just figured pull it up in the email. It's easier for everybody to
Renovation
see.
aficionado.
I
Yeah,
loved that, by the way.
thanks. I had a client in 2011. He was a wine aficionado. We did his house on Flora Place down in Shaw,
Uh-huh.
and we finished the project. He's like, you know what you are? I was like, what's that? He's like, you're the renovation aficionado. I'm like, done. I
I
got it. It's
like
mine.
that.
Yeah, I
So
think, Adam, we should change our business cards to real estate aficionados.
Well, I had a similar situation, and a friend told me that we are approachable professionals,
there you
I
go.
like that.
which I like
Mm-hmm.
that too. So,
I had a client tell me I have my Christopher Walken moments where I walk into a house and I get into this mode where like I would envision what it could look like. And I mean, I could look at the nastiest, ugliest house. Walls are missing, roof is missing, things are caving in, and I could envision what it would look like. I mean, this uh, picture that's behind me obviously is not where I'm sitting, but this is one of the houses that we did, and it was a nightmare before. And so, um, but I would get into these moments where my client's like, you know what you remind me of when we walk into these houses? And I'm like, what's that? She's like, you remind me of Christopher Walken.
Well,
Like,
I mean, it's more like Rain Man or A Beautiful Mind or something. What film was Christopher Walken in that they're talking about?
I think just like his personality and like his mannerisms and stuff like that. So we just
Oh,
kind of
okay.
took it. We just kind of ran with it with my team, and they're like, Mike's out walking the houses again.
Cool. All right. Well, thank you very much, Mr. Pulley. We appreciate your quality time today, and we hope
Yes,
to.
thank you.
I hope to kind of use some of what I learned today, and
Awesome.
hopefully I'm
We'll look forward
disciplined
to it.
enough not to be in the con category.
Right. So.
You're
Okay.
disciplined.
All right.
I believe in you, Adam.
Thank you very much. We appreciate it, and I'm going to go ahead and end the meeting. Have a great day, everybody.
All right. Thanks, guys.
Take care. Bye-bye.
Thank